Hi, this is Tim with HT Trading. Today I want to make a video on a concept that I apply on a daily basis, and I monitor for this throughout the trading session. It's what I call buyer and seller failure, and this usually occurs upon exhaustion of moves, and this is usually a time when stops are taken out or a breakout trade fails. Now, one of my main trades that I have actually is a breakout above or below previous swing, especially at a higher low of the day. And I applied that for the course of a few months, and I noticed that in some situations the trade works out extremely well, and in others I have about a tick in the money, and then I get stopped out with a full stop on the position with no opportunity to even adjust my stop above entry. So what I started thinking was that there's probably a reason where price breaks a couple ticks above or below a swing and then retraces back in the opposite direction. And what I speculate is that it's failure by buyers or sellers, and also institutions taking stops out at those levels. There's a lot of talk in the trading community that institutions will go and hunt stops, and I'm not sure if that's true, but I'll go ahead and assume that, because I've noticed that when I am, let's say, short in this situation, I have a stop above the swing, I get stopped out, and the market goes in my favor. Same thing here. I'll be long with a stop below this swing, I get stopped out, and the market goes in my favor. So I decided to develop a trade based around that concept. Now, the way you recognize it is that you push highs or you push lows. For example, right here, we pushed the current high of the day up. And when you get another attempt at the high, which is right here, you break it, but there's no conviction behind it. Stops get taken out, and you had one tick above the high, and it failed. Then the same thing occurred right here. You have swing low put in. This was actually a trend line of a bull channel drawn from earlier. The expectation was that if price was to retrace to around these levels, this would be the support zone. Now, what you see is that if you did go long in this area, you would have been stopped out for one tick, and then the market would have went in your favor. And usually, something like that happening results in revenge trading, and it's a really emotional situation because you were correct on the trade and you just got stopped out because you were properly managing the position, and then the trade goes in your favor. So what I do is, if I'm assuming this type of failure at certain levels, I actually place a long position a couple ticks below that swing, or a short position a couple ticks above that swing. Now, trading is all about proper money management, so when I do take these failure trades, I actually have a stop of around 8 ticks on the NASDAQ maximum. Usually I like to be around 4 to 6 ticks stop on it, because you don't want to actually see conviction behind the move. You just want to see stops taken out, and then a continuation in the direction against the failure. So these are two examples of buyer and seller failure. This high up here and this low down here. This is what to look for. You want to see breaks of swings with lack of conviction. So usually this happens at, let's say, support levels from on a larger time frame, or upon exhaustion of moves. So it's a thing to be aware of during the day, and to know that they will occur, and use them to your advantage by buying the seller failure and selling the buyer failure. If you have any questions, you could send me an email or check out the blog at httrading.blogspot.com. I'm happy to discuss any ideas that you guys have, or any comments about this if you do apply it yourselves, and how it's been working out for you. So thank you for watching the video, and I look forward to making more in the future.